If you think investing in the stock market means researching companies, cherry picking stocks, and just hoping and praying that you chose the right one, then there's no wonder that you feel stuck or you're afraid to get started, because that is the outdated way of investing, baby. And the good news is that you don't have to actually pick stocks at all. There is a beginner-friendly investment called an ETF, an exchange-traded fund, that spreads your money across hundreds of companies at once with one purchase price. And in this video, I'll explain how it works and why it's one of the easiest user-friendly investments a beginner should start with. But before I get into it, if you are new here, my name is Jocelyn and I am a money coach who teaches women how to invest their first $100 in the stock market and grow their money with clarity, confidence, and education, okay? I lead with education first, strategy second. So let's get into it. Why does stock picking and the stock market feel scary? You know, it can be many reasons. And I've talked with many of my money girls, which is what I call my clients. And the things that they continue to say is that, you know, what if I choose wrong? Like, what if the market crashes? Like, I don't know how to analyze companies. Like, how do I know this is a good investment and I won't lose all my money? And those are all valid reasons why someone should not invest, okay? But the great thing about how I teach is that I teach with education first. I teach with clarity first. And with education and clarity comes confidence, okay? So the fear often comes from thinking investing means betting on one company. That can be an Apple, a Google. And I can see how that can be a fear because we are watching the news all day, every day. We see when things aren't going right and when things are going wrong, you know? But that is why I love ETFs, exchange traded funds. These are essentially a basket of stocks. Think of stocks being these individual companies that you can buy. So instead of just buying out, you know, Google, buying out Apple, buying out Microsoft, you can essentially own tiny pieces of these companies with one purchase price. And that allows you to gain from many things, okay? Number one, it's diversified. We don't want all our money all of our eggs in one basket. Because if we put all of our money in Apple and Apple goes crazy and they drop by 50%, then yeah, we're going to be stressed out. We're going to be worried. So the beauty when it comes to investing is that diversification is the name of the game. You want to spread your money out, okay? Because that leads to the second benefit of a low cost, okay? And a low risk, which means that you are less likely to lose your money because it's spread across multiple companies. And also, you can buy access to these companies at a lower cost. ETFs, exchange traded funds, can be bought with as little as $30, $40. Now, do I recommend that? No, I actually recommend for all of my girlies to start at $100 and repeat that every single month into the same ETF. But if you wanted to start with 30, you can, but just know the more money you have invested, the more opportunity you have to spread your money across multiple companies and ultimately lower your risk. And then lastly, the biggest benefit to ETFs is that, again, it spreads out your money automatically. You don't have to say, okay, I want 10% in Apple, 10% in Google. No, they spread it out for you automatically so that your risk is lowered and the visibility that you have into all of these companies is lower, and you don't have to be some stock market advisor to figure all this out. It does it automatically for you, and it's one of my favorite ways to actually invest. So if you're like, okay, like, can you paint the picture of what this looks like in real time? Of course, I got you. So let's think of something like the S&P 500. So the S&P 500 is essentially a market index that tracks the top 500 companies here in the US, okay? So think of the Apples, the Googles, the Microsofts, Nvidias, Berkshire Hathaway, Walmart, you name it. It's likely on there. All of these big brand companies that basically run our economy here in the US. You can own all of those for one purchase price in one ETF, and that ETF is VOO, okay? That is the ticker symbol. It doesn't mean anything, okay? VOO essentially tracks the top 500 companies and their performance, you know? So the number is going to change every single day because Microsoft can have a good day, they can have a bad day the next day. They can have a good day, they can have a bad day the next day. But the beauty of that is that your money is not just all in on Microsoft, okay? You have money in Apple, you have money in Google, you have money in Nvidia, you have money in Berkshire Hathaway. So even if one of those companies has a bad day, all of your money's not gone. You know, your money is still invested. It's still working on your behalf, because we know that the stock market is just ebbs and flows, ups and downs, ups and downs. But historically, the stock market returns around 7 to 10% annually, which means that your money has an opportunity to grow by 7 to 10%, which is why on my first video, I talked about why you shouldn't lock all your money in checking and savings accounts, because that money's not growing. You have to put your money into investments that are going to grow. And again, exchange traded funds is one of the best ways to get started, because it makes sense to a beginner. I have tons of ETFs in my portfolios across multiple portfolios. So when you think about lowering your risk and investing in ETFs, again, if one company fails, your whole portfolio is not wiped away, okay? It also comes with lower expenses ratios, which is essentially the price, the small fee that you pay to own the investment. It's not something you pay separately. It literally just comes out of the money that you invest every single month. And again, they often have lower costs to owning these things than something like an outright Apple, an outright Google. So that's another huge benefit, because the goal of investing is to make as much as you can with as little cost as available, okay? And then again, built-in diversification. We want that because that allows us to rest and be at peace. If, you know, one company is going crazy for a week straight, these other 500 companies or 499 companies, if we're doing something like VOO, are still going to be performing a little better. And so I'm all about it. ETFs have been something I've loved for a very long time, and they often historically have great long-term growth because that money is spread across multiple companies, and a lot of companies are doing great things at once. And as an owner, a shareholder, a partial owner of these companies, we want a cut of that, okay? We want those dividends. We want, you know, that compounding interest, which is how we make money as investors. And so I'm a huge fan of these. And ultimately, the biggest benefit is that you are not trying to outsmart the market. You are not trying to be some financial advisor. You have other things to do with your life, okay? But you are participating in it. Again, investing is not a spectator sport. Investing is getting in the game and participating so that you learn as you go. Now, knowing this is the one thing, this is one great way to start investing, you probably are still like, okay, understanding investments, understanding ETFs, exchange traded rates, and actually opening that account and investing are two different things, and I totally understand. And if you are tired, okay, of consuming a bunch of investing content, saving all these posts on social media, reading all these books, and just getting into information overload and feeling afraid to take the first step, that is exactly why I created the Invest Your First $100 workshop. And that is where I walk you through where to open the account. Again, accounts matter. I'm going to talk about that on the next video. What ETFs to choose from. You know, I'm not going to tell you to buy VOO, but I'm going to show you how to research an ETF, what to look out for, what are some good expense ratios, what are you paying to own this thing, how do you get paid, do you even get paid, because some of them don't pay dividends, you know. And then we also will be investing your first $100 live together. You will see my portfolio. I will walk you through some of my mistakes that I made so you don't make them, and you have a real-time opportunity to ask me questions and learn from my mistakes, but also to understand my research methodology so that you choose the right investment from the very beginning, but that you also understand the risk associated so that you don't choose something that's going to cost you a lot more in the long run. So again, welcome to the Invest Your First $100 live workshop. And of course, we'll get a chance to get to know each other a little bit too before we really dive in. So I want to just remind everybody that I'm working towards that, but I think for all beginners and people that are new, like, you should really lean into tax-friendly, non-taxable accounts. So 401ks, 403bs, 457s, these are the most common company-sponsored, you know, government-sponsored retirement accounts. I love them because they allow you to essentially get a match. Everybody does not offer a match, but, you know, let's say your company offers a 50%, they'll contribute 50% of whatever you put in there, you know. So if you put $100 in there and they match you up to 50%, then that's $50. And again, I think a lot of times people feel like they don't have access to that money once they leave that company, and you do. Like, I'm in the process right now of rolling over an old 401k from my last job to Fidelity, which is where the rest of my accounts are, so that I have control over it. And I can pay, you know, matters. So this is kind of what we'll go over today. And of course, I'll show you my portfolio. I'll walk you through why I invested and what I invested in. Market returns 7 to 10% in growth every single year. Does that mean it's going to return that every single year? No. Will it return more some years? Yes. What you invest in matters? Absolutely. But historically, it's usually 7 to 10% every year, which is a good thing. Much better than what we'll get from our checking, our savings, things like that. So for year one, let's say you earn 10% in interest. So that $100 now moves to $110. Year two, you're not starting at $100 anymore because you've earned 110 by a variety of companies, a basket of investments, if you will, for one purchase price, So it gives you access into multiple companies. So normally you'll hear people say, oh, I own all these Apple stocks, all these Amazon stocks. Great for you. However, if Apple has a bad day, which they really do, but if they have a bad day, you're going to feel that, and then it's going to throw off your whole day. For me, I prefer to buy ETFs, index funds, because I like my money being in multiple places at once for one purchase price. It's not like I have to go out and buy every one of these individually. I don't have to track everything that they're doing. We can look at this list and we're probably familiar with 7 out of these 10 companies. We probably use them every single day in some way. NVIDIA's behind all this AI stuff, Microsoft, Apple, Amazon. So why you'll love them, because this is where I started with, they are less risky than trying to pick individual stocks and just track their growth. I think there's room for that, but I feel like as a beginner, the best thing that I decided was to go this ETF route, because again, I like my money in different places working for me. I can't go all in on one company. That's too close to just having one income. No, we want multiple streams of income. So they also have lower costs than mutual funds, and mutual funds are essentially peace of mind. It'll just let you know that, like, even if there is a bad day, some companies can do really well and it can help balance your money, balance your portfolio, which is ultimately what we want. Okay, let's see. Where did the comment go? Okay. Okay, cool. Okay, she said, I'm gonna shut down. Okay, cool. All right, that's fine. All right, next is sector ETFs. So these don't track they don't track a whole index. They essentially track like one industry. And so that can be tech, healthcare, finance. I actually do own VGT. They're in my Roth IRA, so I'll show you what that looks like too. And so essentially they bundle companies together based on an industry with the hope it'll grow. And it tends to, lean into trends. So AI is a big thing right now. Healthcare, clean energy, health tech is becoming super popular. So a lot of healthcare organizations are using more AI. Like AI is impacting every single industry. So like if that's something you're really into, then invest, because I feel like they're just slowly removing them. But a good way for you to check, and this is infidelity, is let's say like you want to, buy something. This was an old screenshot. I have more than $4 in there now, but I was like, let's just see what it looked like if I bought $4 of VOO. And then if they had a dollar amount here, then that's essentially what your transaction fee or your trading commission fee would be. I don't believe in paying fees. It should always be zero in my opinion. So if you're buying Fidelity-based funds, or even if you're buying VOO at a Fidelity, like you still shouldn't have to pay fees. But I will show you when I did have to pay a fee, when I show you my portfolio. But for the most part, you shouldn't be paying anything outside of the expense ratio to own an ETF. And last bonus is capital gains. And so I think a lot of people think of capital gains and they think of real estate, because I feel like the two go hand in hand to buy. So like for the workshop, I just added $100 manually, and now I'll be able to manually purchase the index fund. Yeah, it's not a requirement. So similar to ETFs, same types of index funds exist. We know what a broad market is, essentially same thing as an index ETF, sector, bond. They have a lot more international index funds than they do ETFs. I actually have one, so I'll walk you through what that looks like in my portfolio as well. Preguntas. Let's go through my portfolio.
Try this one.
Yes, one at a time. One at a time. REITs ain't going nowhere. But yeah, REITs are good. I'm a huge fan.
You don't have to be logged in now.
Okay. That is in your portfolio. So I know FCROX and FCILX is the most, but all of that is auto populated. So really all you need to do is make sure your ticker symbol is there.
This for a little bit. I think I am too still interested in knowing more about brokerage accounts too, and kind of the benefits of that.
Okay.
Reaching out, as well as, I think for me, the goal is consistency, right? So figuring out how this can be a consistent lifestyle versus just a one-off.
Yes. Yes. The goal with the workshop is to get you to stop overthinking, stop overconsuming information, and to take action. Again, investing is not a spectator sport. This is a get in the game coach and start, okay? And my workshop is a great starting point for you if you have been feeling overwhelmed and just need that clear starting point so you understand what you're investing in, why it matters, where you should be doing it, and how you make money. Because at the end of the day, this is all about making money, baby. So that workshop is happening on Saturday, March 28th, okay? Live on Zoom. It's not something in a class, so no matter where you are in the U.S., baby, you can join, okay? So the link is in the description. Doors do close on March 23rd, so do not think about this too long. If you know you've been ready to start investing, if you know you got money sitting in your checking account, savings account, not growing, then this workshop is for you. So go ahead and click that link in the description and join me there. So, as I mentioned in the next video, I'm going to break down one more investing myth that keeps women stuck, okay? Especially in this economy, you know, because even if you understand at a baseline level what ETFs, exchange traded funds are, and even if you understand that you can get access to some of your money in certain accounts, there are still some mistakes. One big mistake that a lot of women make, especially if they are beginners to the investing in the stock market. So go ahead and click this video on the screen where I will walk you through what that is so that you don't make that mistake as well. I will see you over there.